Right, welcome everyone to another Apt Wealth Partners event, Investing with Confidence in 2026. I'm Andrew Dunbar, the CEO of Apt Wealth. And 2026 is well and truly here, isn't it? We're looking forward to sharing this year with you, and hopefully it's a successful one. Today, we're going to look at some of the major things happening across markets that will shape this year. A quick disclaimer before we start, what's covered today is not personal advice. It's general in nature and should not be taken as a recommendation. And just a couple of things, if you've got any questions as we move through the presentation today for any of the speakers, just use the Q&A box in your Zoom menu there anytime, and we'll get to as many of those questions as we can at the end. We'll also be sending out a recording of today's session afterwards, and any questions that we can't answer, we'll endeavour to answer and send out along with a recording. Well, it's interesting times, isn't it, that we're living in, and there's lots of uncertainty around the world. And it's easy to get caught up in the noise with all the headlines every day. But that's the job of the Apt investment team. And they're here in the background working with our experts to interpret all of those developments and help you make the right long-term moves at the right time. And so today we're going to hear from a couple of speakers. Firstly, Sarah Gonzales, Chief Investment Officer at Apt Wealth, and then Tim Toohey, Head of Macro and Capital at Yarra Capital. And Sarah will briefly have a look at where we're at now, while Tim will give some perspectives on the major issues that are facing markets. So without further ado, let me introduce Sarah Gonzales. She's well known to many Apt Wealth clients. As Chief Investment Officer, she provides portfolio construction solutions for advisors and their clients, and she manages the Apt Wealth Partners portfolios together with her team. So over to you, Sarah.
Thank you, Andrew, and welcome everyone that's dialed into it today. As Andrew mentioned, I'll run through what we saw in markets over the last 12 months and the factors that, our team is looking at for the next 12 months. So just looking back at 2025, it was actually a very great year, very great calendar year for investors, where we really saw positive returns from all major asset classes, as you can see in the chart there, in 2025. Pretty much looking, good, with greens across the board, going down into the lowest return, being international fixed interest, albeit still just slightly above zero. Both Australian and international equity markets delivered double-digit returns, really defying worries about equity markets not being able to produce, the great returns that they've had previously. So this now marks the third consecutive year that equity markets have generated double-digit returns. But what we saw during 2025 wasn't a smooth ride, as we can see in the chart of the ASX 200 and the S&P 500. Really, at the start of the year, we saw equity markets decline as President Trump announced his plan to hike tariffs on almost all of the global trading partners on what he termed as Liberation Day back in April. After the proposed tariffs were paused, though, equity markets really shifted gears and started to recover all they had lost by mid-May and continued to rally for the rest of 2025, with both the ASX 200 and the S&P 500 reaching all-time highs by the end of the year. And equity markets really did this, and ignoring the tariff noise that was occurring during the year, what we saw was President Trump's tariff measures really introduced tariff rates that have not been seen in a very long time over in the US. A lot of announcements came out, obviously, from President Trump, and a lot of deals were made with, the different impacted countries. However, at the end of the day, a lot of the tariff rates ended up settling between a rate of 10 to 20%, which ended up being a lot lower than what was initially announced by President Trump. Another major theme in 2025 was we continued to see inflation easing through the calendar year and really moving towards central bank targets. As you can see in the graph there, particularly in 2025, a lot of countries really starting to move to the inflation running section rather than above trend. Obviously, an outlier there was Australia, which we saw later in 2025, where inflation reached 3.6% for the December quarter, really the highest level for the last 6 quarters. And on the back of that, with inflation easing, central banks were able to remain on their easing trajectory, as we can see there. A lot of central banks continuing to cut rates through 2025. And this really contributed to the momentum that we saw in equity markets. In particular, the US Federal Reserve, cut their rates 3 times in 2025, and we also saw the same from our Reserve Bank here in Australia, who also cut rates 3 times in 2025. What we also saw is equity valuations reaching all-time highs, given that equity markets continue to rally. So both the Australian and US equity markets are now trading significantly above their 20-year averages and near, particularly the US, near their 20-year ranges, at the top of the 20-year ranges. As shown in the chart on the left, the valuation uplift that we saw in the US was predominantly driven by earnings growth, which is good news as companies are growing and growing their earnings. In contrast, though, Australian equity valuation uplifts were predominantly driven by multiple expansions, so your PE expansion and dividends as well, whereas that earnings per share growth not contributing as much compared to the US. Other markets such as Europe and emerging markets trading above their 20-year averages, but as you can see, much lower valuations than what we're seeing in the US and Australia. And so what are we looking at, or what are we focusing on in 2026? In 2026, global GDP growth is expected to slow from 3.2% in 2025 to 2.9% in 2026. So, albeit global growth is slowing, as we can see in the graph in the chart there, you can see a lot of green. So still positive that a lot of economies are still expected to grow, but as I mentioned, albeit at a much slower rate than previous years. Another area that will also continue to be a focus in 2026 is what happens with inflation. Inflation in most G20 economies are expected to continue to fall as economic growth and labor markets continue to soften. As mentioned, Australia being a little bit of an outlier there, so that will impact what our RBA does with the cash rate, which moves me on to the next section in terms of what else we're looking at is central bank monetary policy. As I mentioned, if you can see it in the chart there, for Australia, the RBA isn't expected to make any moves or not projected to continue easing in 2026, given what we saw in terms of the inflation reads at the back end of 2025. However, as you can see in the chart as well, some countries or central banks still continuing that easing trajectory, in particular the US, which will continue to flow through to equity markets as well. So another factor that we're watching. And in terms of opportunities that we're looking at, I think, just looking past the noise, still looking at areas where we see growth and investment opportunities. I think the key transitions that we are seeing will continue into 2026. So technology is going to be a big one. There's a lot of talk around AI. But there's other parts of technology that we're also looking at in terms of just automation as well. So technology continuing to be a long-term trend. I think AI will take a few years to play out. An aging population is another key area. This one's been a long trend as well. So a lot of themes do take a few years to play out. So aging population, seniors housing is going to be a big one. Healthcare is also going to continue to impact that thematic. Climate change, this is quite broad. I think, whilst a lot of countries have slowed down the transition, I think the focus on alternative sources of energy will continue to be a focus for a lot of countries. So I think climate change is still going to be a long-term trend as well. And one factor that's going to be remain key, and we're seeing it in the news daily, geopolitical tensions are just at an all-time high at the moment. And this really emphasizes the need for diversification in portfolios and building resilience in client portfolios. Which leads me to, what should clients do, particularly in periods of uncertainty that we're seeing right now. It's really important to stick to the plan. The plans that you've created with your advisors will factor in instances of volatility and uncertainty. So sticking to your long-term plan, maintaining a buffer of safety, re reassigning your risk profile, rejigging your risk profile to make sure you're not overexposed to risk assets. So looking at your risk profiles and making sure that it's aligned with the level of risks that you want to be exposed to in client portfolios, but also taking advantages of weakness. Volatility creates opportunities to invest into the market. So, viewing volatility as opportunity for client portfolios, focusing on quality investments, partnering with managers that are aligned with our philosophy and meeting our client objectives, as well as looking at investing in companies that have good earnings growth outlooks and good cash flows is really important. As I mentioned, diversification is key, in particular with, as we saw in the diverging returns from different asset classes. No one asset class performs the best each year. It changes, so that's where diversification becomes really important. And as I mentioned, regularly rebalancing client portfolios is really key. So that's the key areas that we're looking at and how we're positioning client portfolios for 2026.
That's great. Excellent, Sarah. Thank you for that. Yeah, there's a lot to keep an eye on. And I think, as you say, being a long-term investor rather than short-term speculators is the way to go. So thanks to you and your team for all the work you're doing. All right, if you've got any questions as we go through, just a reminder, use that Q&A box and we'll get to those questions at the end. But it gives me great pleasure to welcome Tim Toohey, who's the head of macro and capital at Yarra Capital, who's an investment partner of Apt Wealth. And Tim is one of Australia's top economists. And in fact, amongst his 25 years experience, he was voted Australia's #1 economist for 13 consecutive years, while chief economist at Goldman Sachs. Well done, Tim. Tim works closely with our team, providing a perspective on financial markets. So keen to hear what he's got to say. Over to you, Tim.
Well, thanks, Andrew, and thanks, Sarah, as well. Look, there's a few themes I want to touch on today, and without overstating the case, I do think, as both Sarah and Andrew highlighted, there are, as we move through those initial shocks that we saw in 2025, obviously the tariffs in the US were the largest. We are still left with a number of issues that question, I guess, the sustainability of asset price returns and economic growth, and it's just trying to get to the bottom of it. So we are left with some high market valuations, but at the other hand, we have very loose financial conditions, particularly in the US. We have, for instance, very high levels of margin lending in the US detectable, but we've also got some pretty unsettling fiscal settings as well in many developed nations. And we've also got this issue, which I want to touch on a couple of times, that the economic growth, although it looks reasonably strong, it's very bifurcated, with particularly wealthy households appearing to drive most of it, and tech spending as well. And in the background, we have this sort of strange situation at the moment where we're in a very low firing but very low hiring environment. So employment momentum has actually been pretty weak across most of the developed world. And with low employment growth, you tend to expect it to generate reasonably low income growth. Now, in terms of getting to the bottom of all these things, one of the things that I kept coming back to through the course of 2025 is that in the case of the US, we finished the year with a whole lot of optimism that got built in. If I went through most of my sort of peer group and the external strategists, almost to a person, they've come into 2026 with quite an optimistic outlook. It stands in stark contrast to where they were when they were moving into 2025, by the way, where most of them had quite a pessimistic outlook. So in contrast, coming into 2025, actually quite an optimistic outlook. I thought EM would do very well. I thought US growth would remain resilient, and we had a pretty positive view on equity markets. So in some ways, it feels a little bit juxtaposed that we've got to the end of 2025 and into 2026, and the views have turned 180. Most people are very optimistic. They're very optimistic on markets. And I guess one of the core points that I'm just trying to make is, I don't think the easing cycle is over, because I still think there is something of an interruption in growth that comes into the middle part of 2026. And it has a lot to do with the way that the US has positioned itself into the midterm elections and the type of uncertainty that's likely to emanate there. It's also just a function of the fact that what I think is that the US growth has probably been somewhat overstated relative to what's actually going on in the underlying data. And I'll come back to that in a moment as well. Now, we will get rate cuts, though, mainly because the Chair Powell will be handing over the baton to someone who's quite dovish. Now, you can choose which one you think is the favoured candidate at the moment, but without question, President Trump will not only be choosing the most dovish central bank chair, he's also got the increasing, or quite a strong likelihood that he'll get to add at least another one, maybe two other members to the FOMC board through the course of this year. So it will increasingly skew to people that are very, very dovish as we move through the course of the year. When we move through to the broader view beyond the US, I'm actually still pretty upbeat about what happens in the emerging markets in general, and emerging markets, Asia and Europe in particular. Now, part of this is the China story. Part of it is just a story of excess liquidity that's built up in the region. And I think that's going to continue. And it's a really important aspect of what will probably drive broader asset market returns this year. And I'll come back to a couple of charts that try to reinforce that. In terms of Australia, I feel a bit like Robinson Crusoe here, because we've seen a lot of people jump off the view that the RBA will remain on hold in the first half of the year. Most of my peers, competitors, are suggesting the RBA will be hiking as soon as next week. I do have a different view on this, and I will spend a bit of time talking about it. But in essence, it does come down to partly the idea that we're seeing quite a marked tightening in Australian financial conditions at the same time that US financial conditions are easing sharply. And this is really unusual. And a lot of it has to do with the trajectory of the dollar, but it's not just that. Typically, when you see a tightening financial conditions, it's telling you that economic growth is going to slow somewhat in the year ahead. And I'll come back to exactly how much I think that's going to occur and why the RBA will be wary of that. In terms of asset market performance, I still think EM is going to outperform the US. And Australia, I actually think will actually do better than the US this year, partly on a rotation in the US market itself. But again, I'll come back to that in a moment. We actually do continue to favour, as a house, smalls and micros in the local market, which have done very well since Q3 of last year. First of all, let's start with the US, because that's where most of the noise is emanating from. You would have thought that 2025 was the peak in geopolitical risk to come out of the US. Well, the early part of 2026 has proven us to be ratcheting it up to a whole new level. When we look at the tariff side of things, well, one of the most famous phrases we got out of last year was the taco trade and the view that Trump would always back down. Clearly, though, when you look at a chart like this, and where tariffs actually settled at, so the effective tariff rate in the US is still around about that 13 to 14%, markedly higher, as Sarah said, relative to any period we've really seen since the 1930s, and it has been generating some real revenue. Now, most researchers, most economists would suggest this is US consumers that are actually paying this tax rather than other countries. But you can see here that they're actually well on track to earning around about $300 billion in revenue in 2026. Now, the key question has been for a while now, what's he going to do with the revenue? Now, bond markets had somewhat assumed that some of this revenue would go into debt repatriation, paying down the US's enormous build-up in foreign debt. But the point is that it's increasingly likely that that's not occurring. You've already seen $12 billion handed out farm subsidies recently. Trump wants to do a consumer dividend, and that looks like it could cost something in the order of about $170, $180 billion. So you can chew through a lot of this revenue fairly quickly. And of course, given that the president's polls are sitting around about 35% in terms of favourability at the moment, he needs to see a very marked turnaround in both the way that consumers are viewing affordability, the way they're viewing the economy, the employment outlook, but their own finances more broadly. A lot of this projected tariff revenue is going to get recycled back into the economy through the course of the year, and particularly into the mid part of the year. Now, Greenland's got a little bit off the radar from when I put the presentation together a week ago, but it's worth just sort of putting into some sort of context. And I'm putting into context of the idea that they were willing to pay for Greenland rather than invade. So there's a little over 57,000 people in Greenland. Some discussion would cost around about $1 million per person to buy it. So you're talking in the order of $58 billion. So again, in the context of the farm subsidies, the consumer dividend, these sort of ventures can really chew through any additional revenue that Trump is sort of amassing on the side in terms of tariffs very, very quickly. Of course, if the broader objective is to move through the whole of the Western Hemisphere, well, and I am sort of joking at this point, there's 660 odd million people outside of the US and the Western Hemisphere, so obviously that would sum up to a very large sum indeed, which the US clearly can't afford. And this is sort of the point, because not only does the 2026-2027 year mark the year where the US budget deficit will blow out. This is where most of the expenditure from the big bill hits, and before any notional savings kick in a little bit later on. But the trouble is that the tax bill adds about another $3.3 trillion to debt, including interest. So there are some temporary provisions that were in the bill that, if they're made permanent, like they always are, will actually make this chart look even worse. So, the bond market's a little bit nervous about all of this, and I think rightly so. So it does give a growth impetus. I'll touch on that a little bit more in a second. But you can see that just in terms of the interest bill alone, so this chart is really just focusing how much the interest bill alone, you might be aware that US interest is now almost as much as what they spend on defence. So it's an enormous sum that they actually have to pay each and every year. But if bond yields sit around about where they are at the moment, it's pretty, and we see some of these provisions that were in the bill made permanent, you can see that it really becomes quite problematic over the next 5 to 6 years. My point is that on current bond yields, on that type of projection, you'll get an interest bill that starts to exceed the rate of US nominal growth. And when you get to that situation, that's when debt becomes a little bit explosive. And you can see the bond market starting to be concerned about it. This is just one different way to look at it. Term premium is just a fancy way of bond markets asking for increasing insurance for holding long-term debt. And certainly they've been asking for more insurance really over the course of the last 18 months or so. But you can also see it by the steepening of longer term. So they're asking for more compensation the further out you go along the US bond curve. So the gap there between 5-year bonds to 30-year bonds has continued to steepen up. So even though there were geopolitical concerns, even though there's some concerns about whether the growth in the US is sustainable or not, you could see the bond market was basically still saying, no, I need more compensation because I'm getting concerned about the level of debt in the US and whether they're actually going to try and do what Trump promised and actually try and repair some of the budget deficits. So the economic impact of the big, beautiful bill, well, we'll start to see it pretty quickly. So the main way that you're going to see it in the data is really, pretty much from Australia Day forward, they can claim their tax refunds in the US. It's very, very seasonal. I'm just showing you the month-to-month patterns down the bottom of that chart, how it looks, and the red lines are just looking at through the year how much it would be in terms of an additional boost to consumer incomes in the case of this particular tax bill. So yes, it did skew to the wealthy in terms of where the benefits lie, but it does add up to a pretty decent increase in household disposable income over the course of the year. That'll turn up in spending, no doubt. But importantly, it'll happen largely during February and March of this year. So there will be a very, very near-term effect. And you might have detected this even from last night, but Chair Powell was basically indicating that he's a little bit more optimistic that the data in the near term will be a little bit better, and you can largely put it down to this type of impetus that's coming through. Point is, it's temporary, and the second point is potentially it's already been consumed ahead of time because we've actually seen consumer spending hold up a lot stronger than the underlying pace of household income. But the third point is, of course, that it is skewing increasingly or largely to very wealthy households. I did mention that there are different ways of cutting the data. US economic growth has been very solid. You can sort of get a sense of that from the left-hand side. It's been growing above us more recently. But if you sort of look at the right-hand side chart, that's an alternative way of measuring growth, where you sort of, and this is us pumping all the data that's really relevant and available in the two economies and putting it through to a fancy statistical process to try and decipher the underlying signal to economic growth. And I would argue that when you do that for the US and you look at things like just how subdued a lot of the business sentiments are, the consumer sentiment is, what the way that we've seen housing actually deteriorating at its fastest rate since 2008. Investment we'll talk about in a second. XAI actually looks pretty weak. For instance, very low employment growth. You can make a case that Australia's actually been growing at, or if not better, than the US in terms of the underlying tone of the data. So yes, the data looks strong from the way that GDP officially is measured, but the general tone of the data just really hasn't supported what we're seeing in the headline GDP numbers. We've also seen this in the labour market, where you've seen this very strange bifurcation really here as well, where people turning up and asking for insurance, for unemployment insurance, so initial jobless claims, has actually been rolling over. It looks reasonably low. The unemployment rate, although it might have improved slightly last month, it's actually been trending higher in the US through time, really over the last 2 years. And importantly, economists sort of use this rough hand measure of when a recession is potentially likely by something called the SARM rule. And it really is just a function of how fast the unemployment rate is increasing relative to its 12-month average. And every time the SARM rule is triggered, you tend to have a recession. So the only point that I'm really making here is, the last time we had a real flutter in markets was in the course of 2024, where there was some risk of recession that came through briefly on the SARM rule. But we're only 0.2% away in the unemployment rate from actually triggering it again. So, again, the labour market is actually pretty soft. There's not a lot of employment growth. There's just not a lot of firing that's been going on. But if we do start to see some retrenchments, and even Amazon last night announced that they're going to do a round of retrenchments, then that could change. And I'm just making the case, and that sort of goes into Sarah's point, narratives can change pretty quickly in markets. There's a lot of optimism we came into the year. If that optimism was to change it would certainly be around about the shift in sentiment you're seeing in some of the surveys, particularly consumer sentiment, and of course, if the unemployment rate actually does trigger the SARM rule over coming months. It's not a prediction, but it's really just to make to note that we're not that far off that on that measure. The other thing I find interesting is that you can look at charts like this, and I can show you a couple of others that are reasonably good predictors of where the unemployment rate tends to go historically. And they're basically signaling that any improvement that we're seeing in the unemployment rate is likely to be just temporary. It's likely to keep trending higher. In this case, this is really about people that are actually out of the workforce who want a job, which tends to be a good predictor of where the unemployment rate goes. There's measures inside the consumer surveys like the Conference Board that are also very good predictors, and they're also giving a very similar signal. So I don't think the debate is done on whether the US unemployment rate has stabilised. I think Chair Powell last night actually jumped the gun a little bit on this and signalling some victory on this. I really do think that was a bit too soon to reach the conclusion on the evidence we've got in the data. And perhaps just finally, and this one is really going to a separate type of discussion. What I'm trying to show on these two charts is that the effectiveness of monetary policy is actually diminishing. So in the US, you're probably aware that monetary policy is really being governed by the long end of the curve. So mortgages are set off the 30-year rate in the US. And if the bond market wants increasing compensation for the debt that's in the system, then the Fed cutting interest rates isn't really having much of an impact on the long end. And from that perspective, you're not getting much easing. But the other point that is not discussed, and I find really interesting, is there's been such a surge in deposits from US households. It's actually about the same level as US household debt. So lowering interest rates will just cause, if you like, some households to feel better, but others to feel worse. The savers will feel worse. And given that the two numbers are broadly equivalent in the US, not true for Australia, which is what the right-hand chart was trying to show. Now, it's a little bit, the effective monetary policy here is a little bit less than it's been in the past, but it's still very effective. You can make a case that in the US that, this huge shift in people having money on deposit, money in mutual funds, in cash accounts, is actually going to be offsetting the type of impact that we've been used to in the past of prior interest rate easing cycles. But it also speaks to why I think we actually get additional easing in the US. They'll have to go harder to get the impact that they've decided previously. I mentioned the AI and investment side of it. It's impressive how much money they're all wanting to spend. You might have seen even last night that Meta now wants to spend about $120 to $130 billion in capex over the next year or so. They're truly mind-blowing numbers. But in aggregate, the chart looks like the one on the left. Yes, business investment is in aggregate okay in terms of the rates of growth that it's pushing through. But ex-AI related areas, business investment's actually slightly negative at the moment. So it's incredibly concentrated in just this one sector. And what I find interesting as well is that when a lot of economists are talking about the economic impact of AI on the US economy, they're not netting off the imports of it. A lot of the components are actually imported still. So the net impact on economic growth, I think, is actually being overstated. We saw this in Australia during the LNG investment boom, where a lot of economists saying this is going to be great, this is going to be such a strong story for Australian economic growth. But when you net it off the imports and the idea that they don't really employ a lot of people anyway, particularly in the operational phase, the economic impact was relatively transitory. The right-hand side chart is just making the point also that small businesses really aren't feeling the love as well. The NFIB survey is really a small business survey, but that's where most of the people are employed. They certainly haven't really been lifting their capex plans very much at all over recent months. So, again, it's very much a story of some very big companies doing some very big things, but not employing a whole lot of people in the background. So one area where people were quite nervous, I think, were quite pessimistic, and certainly the narrative has been pessimistic in Western newspapers and I think on your news channels, is that China's somehow in some sort of economic funk and they're unlikely to ever grow out of it. It's just complete nonsense. China's been doing just fine. I mean, the law of large numbers alone, if you're growing at 5% from a GDP perspective year on year, and you were doing 5% 10 years ago, then 5% this year is still an enormous amount of incremental demand that's being generated. The point here is that in the areas that actually matter, so if you're looking at industrial production, actually making things, areas like computers, shipbuilding, chemicals, I'm just showing on the left-hand side, there hasn't been any slowdown. In fact, there's been acceleration in total, like total industrial production across that economy. Show me the slowdown. It's quite minimal, if at all detectable. Part of the story's been they've been able to do the right-hand side chart. They've actually put sufficient stimulus in the economy. So total social financing is a measure of how much credit growth they're really pumping into the economy. And they started that really in November 2024, but it created a nice catalyst through the course of last year. And it still is in the system. It's still providing enough stimulus to be running at an above trend type rate, notwithstanding the fact that Chinese housing construction sector still remains challenged. The rest of the industrial base is doing just fine, and they've actually taken up global market share in terms of their exports over the last 18 months. And in many ways, the rest of the world is now making stronger linkages back into China rather than less, given the advent of tariffs and the advent of Trump's rhetoric as well. So China doing what it's been doing is actually going to be quite a good support for that whole EM trade. A weaker US dollar, which is a function of pretty much everything I've just said in the prior discussion, will also support that EM trade. And although it was a very good place to be last year, it's likely to be still a pretty good place to be this year from an investment perspective. The main reason for that is it's not just about China, and I really just want to focus on this left-hand side chart because it gives you a sense of one of the best sort of longer-term leading indicators that an economist can have, really, is something like this one. It just gives you a sense of how much excess credit is in the system. And if there's excess credit growth in the system, you can be pretty sure that the real economy will follow it in time. And my point was, this was detectable this time last year. It's even more detectable this time this year. And if that's right, then EM asset classes will actually follow the trend. It's also one of the reasons, and I will note, of course, that the Australian dollar's been for a great run over the last couple of weeks. We've just gone through 70 cents. It's also one of the reasons why the Australian dollar was always likely to go for a run, and it will continue through the course of this year, I think. So, again, the global growth story looks better through this prism than just purely thinking about it from a US-led growth perspective. Now, having said that, this is a really important chart. It's a really important chart for the Australian interest rate outlook as well. What I mean by financial conditions, well, financial conditions are really, what's going on with interest rates. Central banks are doing, sure. What's going on with longer-term interest rates and along the yield curve is important. But it's also what's going on with equity markets, what's going on with corporate bond markets, what's going on with currencies. I used to build these things for Goldman Sachs. So the point is that the Fed uses a financial conditions framework very similar to this for the US. And I taught the RBA how to do these things for Australia as well. So I'm pretty sure that the RBA should be aware of the fact that we're getting this unusual wedge that's opening up and this looks worse over the last few days than what it does from last Friday. And I did this chart because the Australian dollar's gone up a lot. The trade-weighted index has risen about 4 cents since the last RBA meeting. And of course, what we're seeing is that conditions here have continued to sharply tighten, and then the US have actually eased because the US dollar has gone down a lot over the last week as well. The point is that any sensible central bank would say, well, at the axis here, or the black line in the middle, that's essentially where policy is neutral. And so what we now have in Australia is financial conditions have actually tightened up inadvertently to the point where it would actually be generating economic growth 12 months out that looks a bit more like this now. So it was on track to be expanding at slightly above 2%. It's now coming in at under 1.5% on today's update when I was doing this 12 months out. Is that going to leave Australia at having excess demand or bumping up against capacity constraints? I would suggest not. So the best course of action for the central bank, in light of what's happened to the currency, should actually be to pause and assess. We'll have a discussion about the inflation dynamics in a moment, but also just bear in mind that the drivers of growth have also shifted in Australia. We're actually getting a much better tenor now out of private demand indicators, but public demand is actually starting to peak. And even the state-based investment projects are actually starting to trail off in terms of their contributions to growth. Now, as private demand rises, so will productivity growth. Productivity growth around about 1%. We're pretty much there already. It's running about 0.8%. Is not too far off where the RBA wants it. Wages around this sort of level, 3.5 to 3.7, productivity around 1% is ideally where they want it. And we're pretty close to it. So there's a narrative that productivity growth is terrible and wages are too high. Well, wages have come in below what the RBA have been looking for about 5 quarters in a row. And productivity growth has finally started to show a better tenor. It will continue to improve as areas like consumption, dwelling investment and business investment come through as the drivers of growth over the course of this year. So I think, again, the RBA should actually be looking at this from a different perspective than what they appear to be currently doing so. This chart is just sort of looking at how the composition of what we're seeing in the inflation data, how that's been shifting. Now, there's different ways to cut the inflation data, and I don't want people's eyes to glaze over too much. Most economists are inflation nerds. But the point is that around about 40% of the CPI basket's actually below the bottom of the target band. So about 40% of all the items in the CPI basket are actually growing below the bottom of the target band, the 2 to 3% perspective. And even after yesterday's data, there hasn't really been a material upshift in the distribution of the underlying components in the basket. Now, there's been a lot of noise and there's been some individual components, which I'll have a quick chat about in a moment. But what the central bank has historically looked at is when there is a bigger uplift. So if you sort of cast your eye here to going through 2022 into 2023, you can see there was a very sharp uplift in the red line, for instance, the proportion of items in the CPI basket that were growing above the top of the CPI band. We're doing nothing like that at the moment. It's actually not much different to where we were when we started the easing cycle. So I do find it interesting that inflation yesterday printed in line with expectations, yet the whole market has jumped to a view. It's about 70% price that the RBA will be hiking in February, and some very loud voices are suggesting there should be multiple hikes. I really don't think the data justifies that. Typically, when inflation distribution is this friendly, you're actually well into an easing cycle and you continue into it, not a hiking cycle. There were some one-off effects. Put very simply, if you stripped out the impacts of a couple of things, in particular the electricity subsidies, and if you stripped out the impact of tobacco, inflation is running at 2.7%. Now, why should you do that? Well, the electricity increases were obviously just coming off the subsidies that were provided. We've actually seen, by the way, wholesale electricity prices are actually coming down quite sharply. So, we shouldn't be too fearful about the future of electricity prices as the subsidies continue to wean off. But also, just bear in mind that the tobacco component, in general, taxes are a large component of what's been driving the domestic inflationary impulse. Now, we can debate the impact of taxes, but for the case of tobacco in particular, every retailer knows that tobacco sales, official tobacco sales, have fallen dramatically, and the unofficial market, the illicit market, is growing exponentially. But the statistician doesn't take any account of that. They don't make any adjustment to that. So if they did, it would actually lower the inflation numbers by about 0.2%, just from that story alone. You're also getting some one-off effects. We've had a big surge in meat prices. We've had a big surge in gold and silver, which has largely impacted what's going on with US policy rather than domestic demand. So again, I don't think there's a strong case to be made that whatever inflation we're seeing domestically is a function of either capacity constraints or excess demand growth in Australia. We seem to have such low growth ambitions in Australia at the moment that any sign that we might actually grow to something that looks like approaching a potential growth rate, even after a long period of growing below it, is something that should be snuffed out at the first instance. I really have a problem with the way that the discussion has evolved in Australia over the last little bit. And again, particularly because we have this sort of scenario at the moment where productivity growth looks like it's starting to improve into much weaker population growth. And you can also sort of make the point that a lot of the wage growth that we've seen across the broader economy, given what we know that's been going on in terms of national income growth, it's likely to continue to slow rather than show signs of improvement or re-acceleration. So for many sort of ways of cutting it, whether you want to think it through productivity or unit labour costs, or whether the inflation impulse is actually a genuine reflection of demand, or whether financial markets are doing the tightening for the RBA already, which I would argue clearly it is, there's just not a strong case for them to actually go. Now, having said that, financial market pricing, as I say, it's about 70% this morning that they go in February. They got stung when they rejected financial market pricing in July of last year when the market was expecting an easing and they deferred it a month. So they might be somewhat sensitive. We'll need to see over the weekend the RBA sort of walking it back somewhat in terms of the financial market press for them probably not to go. But my biases and my analysis suggest there's no way they should be doing it. I'm not going to go through the housing market in a whole lot of detail. It's been a story that I think we're all sort of familiar with. This is a record undersupply of homes going back as far as I can sort of do the data. It's clear that approvals have picked up. It's going to be a supportive area for economic growth through the course of this year. If anything, if I'm right, then and we actually end up seeing not the end of the easing cycle and it reestablishes itself later this year, then it will continue. And we actually do need it in order to avoid some clear social issues that comes off of an undersupply of housing of this magnitude. So it started to happen partly because of 3 rate cuts that we had. Reversing course on that could snuff it out a little bit, but let's hope that's not what actually transpires. The real story that's actually driving the recovery is just quite simply this. We were in a terrible position for real household income growth, and it started to improve. And from cash flow, from a cash perspective, what households actually have in their pocket, it certainly improved late last year. And that's obviously come through in some better data in terms of around consumption, retail sales and the like, really through that October, November and December period. All of that's good news. The reason why cash flow really improved had a lot to do, well, not so much the fact that, debt servicing went down a lot, and not even so much that the tax cut helped a whole lot. It's both at the margin helped. It was really just the case of a lot of the things that had gone up in price a lot started going up at a lot slower rate. So the things that we were much more concerned about in terms of particularly rent, food expenses, electricity, operation of motor vehicles, those sorts of things, particularly insurance, started to moderate. And this moderation on the right-hand side, relative to pretty sticky wages growth, helps generate a lot more free cash flow for households. And that's, in essence, why the consumer was feeling a bit better into the end of last year. Now, the point is, is that a good thing or a bad thing? That's actually a really good thing. We shouldn't be, punishing the consumer because some of the things that were causing inflation and causing a squeeze on cash flow has started to moderate or normalise. They're a long way from getting back to the pattern that we saw in the pre-COVID period, by the way, but we're on that sort of trajectory. And again, if you saw those things sort of moving the other direction and you see a breakout in inflation expectations, for instance, then you might have more concern. But that's clearly not what's actually been going on. It's actually been a good news story, helping to facilitate the story around the consumer. So just quickly, just sort of on the Australian dollar, one of the reasons why it's doing better is, I think, partly a reflection of, as much as we go on about Australia's fiscal finances in the financial media locally, this is the actual picture against our peer group. Yes, our government net debt has risen a little bit, and it's projected to creep up a little bit further. But it's not even the same postcode. It's not even the same planetary system as what we're seeing across most of the G7. And of course, it's at the rate of change in these charts that actually matters most as well. We've got an element of stability here kicking through. And at the moment, from the budgetary perspective as well, so moving from the movement in debt to just what's going on with the budget deficits year to year, ours is currently projected to basically just stay around this sort of 1% level. In the US, it's quite likely we're going to be sitting there at around about 5.75% to 6% budget deficits throughout the next 4 to 5 years, and that's really the problem. So if you're an international investor and you're worried about debt escalation and you're sitting there looking at Australia with interest rates at the moment likely to remain reasonably constant, commodity prices picking up, and interestingly enough, we're actually getting some positive net debt investment flows, both from the equity side and from debt flows. We can certainly speak volumes of that from our own business, Yarra Capital. We're seeing quite a lot of Asian investment flows, particularly Japanese investment flows into our fixed income products and our equity products, which is of particular interest to us at the moment. And part of the reason for that is because Japan interest rates have moved as well. The hedged yield, both in terms of corporate bonds and even government bonds, is so much more attractive than it has been for years. So we think that's going to continue. It's going to be the other sort of supporting force for the $8 over the next little while, in conjunction with the Fed cutting rates still, the RBA somewhat on hold in the first half of the year, commodity prices doing well, emerging markets doing well. You really does have the prospect, or when you're thinking about your investments, I think why you probably should have a bit more of a higher hedge ratio at the moment, because the prospect of these sort of positive capital flows coming into Australia is actually still pretty good at the moment. So we've gone through pretty much what I thought were most of the important sort of thematics for the year. I might pause in a moment and see if there's any questions, but this sort of one of the key features of why the Australian dollar is going up is really those forces I just mentioned. It's quite feasible we'd be looking at a 72, 73, maybe even a 74-cent currency, depending on whether the US can put the brakes on the current momentum of outflows out of the US over the next 3 or 4 months. I might pause there, Andrew and Sarah, and see if there's any questions.
Yeah, fantastic, Tim. Thank you for that. And the headlines are great, aren't they? But I think it's great to sit back and form opinions with the real hard data supporting it. So thanks for that. It was fascinating stuff. We do have a few minutes for questions, and we've got a couple that have come through already. So if anyone's got any questions, please use the Q&A box, and we'll get to as many of those as we can. You both talked about the level of geopolitical activity at the moment and interest rate activity from central banks as well. They're really dominating the discussion. But Tim, if we break it down, what do you think the biggest number one risk is now that markets aren't taking seriously enough?
Yeah. So the reason why I'm a little bit more cautious about what's going on in the US is I think what we're seeing in Minneapolis, what we're seeing in different parts of the US is somewhat of a forerunner for what we're going to see through April, May, June of this year. Yes, I'll pull back and retreat somewhat for now, but the strategy, I think, is voter suppression. The strategy is Trump desperately wants to retain control post midterms. And given the starting point, I think he'll stop at nothing really in the interim. So I think that's going to be quite corrosive for confidence and in the US. And I think it's going to facilitate some of the trends like on this chart that we're going to see. So I know a lot of people want to double down the bet on the US. It's been a great trade for the last couple of years. I'm just a little bit more circumspect. We're obviously also in that phase of you probably have all sort of read to some degree about the recycling of capital amongst the big tech names and supporting the suppliers as well with these huge investment plans. The trouble with huge investment programs is that they tend to be more expensive than when you started off. And obviously, everyone's in this put race at the moment and trying to compete for future returns. And there's only going to be a couple of winners there. So you're placing big bets on individual companies, not knowing exactly how that's going to play out. And there's going to be some pretty significant capital destruction at the end of that for some, for some of the ones that don't come to bear. So, again, I'm a big fan of when companies are making, turning a whole lot of free cash flow, they're building up their cash balances, they've got a lot of optionality. I'm always a bit nervous when companies go into big capex and, here's the big idea phase, and that's where we're at, and it's somewhat marginal, margin destructive. So, I just think that some of that, and I think as Sarah pointed out, a lot of PE expansion sort of has happened. Some PE contraction can come in that phase, even if nothing fundamentally actually changes from the earnings in the very, very near term. People can just have some doubts and look for other opportunities for a while that capex and that market share argument is fought out. And if in the background you've got a whole lot of uncertainty into the middle part of the year around how this election is going to pan out, then I just think that's actually the risk. I'm not that fearful per se that there's a recession that no one is seeing. I just think people have actually got a little bit too over their skis in terms of optimism at the start of the year. I think the real data's been a little bit lower than that. It's probably not getting that much worse at the moment. So I'm not that fearful that we're about to take a big lurch down, but I just think there's too much optimism that's been built in for now.
Yeah, that makes sense. And I suppose, as Sarah's been talking about with the stretch valuations over there, Sarah, that's why you've taken a bit of an underweight position to the US in recent times, right?
Yeah, correct. Touching on, just as I mentioned, equity valuations, US market reaching all-time highs, and noting the issues that Tim has just gone through, looking at reducing our weight to the US and diversifying away into other countries again, looking at that diversification piece and just taking some profits on investments that have just really rallied over 2025.
Yep. And then, so Tim, if we flip from the risks to the opportunities, where do you think the real opportunity for investors that might be being overlooked is at the moment?
Yeah, so it's sort of interesting. I mean, there's a few. I mean, we're a bit cautious in terms of, well, I'll start with equities and I'll move into some of the other asset classes. So we've obviously had a very good start of the year for the whole commodity complex, and that feeds into that whole EM trade that I was talking about, and the stronger $8. Obviously, when the $8 is going up, it's somewhat reflective of that sort of same theme. So I've had a bias towards base metals, which certainly has had a very strong start to the year. But we've also had a bias last year, and I've held it again for this year, that micros and smalls are going to do better. And this is, in partly a function of an improving economy. They tend to do better, partly because when the $8 is going up, a lot of these guys are actually importers, so it becomes margin expansive. And you do have some lower interest rates, which will obviously impact them as well. So you're getting, if you like, operational leverage, you're getting financial leverage, you're coming from a reasonably low base. Some valuations are starting to creep up somewhat, but there's actually some pretty attractive EPS growth in that part of the market on offer, if you believe the analyst numbers, over the next 12 to 18 months. So, it does look to be at a good spot, particularly if the $8 continues on its trajectory. In the credit space, look, we're more a fan of public markets and private markets, and we have, I guess, had this position for some time that we thought we'd get this steepening of curves occurring. We've certainly had that. If you're looking at the Australia differential to the US at say the 10-year rate, we're about 50 basis points over the US at the moment. So our bond yields look, I think, very high relative to the fundamentals vis-a-vis the US. That gap should be narrowing, I think, over the course of this year. But equally, it's still a reasonable running yield that we're getting across our fixed income buckets. Obviously, corporate bond spreads are relatively low, but they're very low in the US, they're relatively low here, but the all-in run yield is actually pretty attractive still. And we do think that if we're looking going through the risk of those, of the investment grade quality paper that we invest in, at least we're still very comfortable with the risk reward there. So we've been having very strong flows into those types of products in our shop as well. And I think, the rationale there is it's an attractive running yield, but it still looks, if the economy is improving, it should still be a reasonably safe place to be. There might be more oxygen, more sort of a high beta play in the micros place, but that obviously comes with a much higher risk reward scenario. Banks still look challenged. Obviously, the big resources are going to follow somewhat where the base metals are going, but it's a bit trickier, we think, playing in that the ASX 20 space. There's just a lot more optionality, we think, below there.
Yeah, that's great. And Sarah, I think that supports you and your team's view in relation to both the opportunities in smaller companies and also on the defensive side, just positioning for that defensive income.
Yeah, correct. As I mentioned, if we looked at Australia, a lot of the uplift was through PE expansion and dividends, and as Tim mentioned, that top ASX 20 looking quite challenged, and so looking at our exposures, particularly in that mid to small cap space, not just here in Australia, but also globally. So looking for opportunities in that area. And as Tim mentioned, in a fixed interest space, we have seen bond yields tick up a little bit, but the yields that you are now getting, both actually from your traditional bonds and on the credit side, particularly investment grade, on the higher quality end, the yields that you're getting now, looking at the risk reward, you're being compensated for the potential risks. So looking at expanding our credit exposures in our portfolio.
Good stuff. Now, we're running out of time, but there's a really good question here, Tim. You talked a bit about China and showed us the data that they're doing well still, and the growth rates are solid. There's a bit of stimulus as well happening. This question is talking about what the longer term impacts might be of the aging population there and the declining birth rates and what that might do to some of that growth.
Yeah, look, Andrew, I wrote a piece, I reckon about 5 years ago, and I couldn't get a journalist for love of money to notice it. And then basically what I was doing was the Chinese census had come out. It was in Chinese. It hadn't been translated into English so much. No one had really noticed it. But there was at the time there was a very sharp drop off in the birth rate, and you can take that type of data and put it through population simulators, and it was pretty clear that everyone's projections for Chinese population growth were miles wrong, and it was conceivable that over the next 30 years that their population could fall by about a third, which is pretty much unprecedented. So enormous, right? So and they had, in the lead up to that sort of shoe dropping moment, was they were already investing in areas they thought they needed to be building global capability in productivity enhancing sectors. So it's certainly up the ante. Obviously they've done a whole lot of things which are trying to boost the fertility rate, but there hasn't been a policy that I've seen successful in any country at any time that's been able to do that. And it comes back to a phrase that we've seen touted around the US and here a lot. It's affordability. Affordability has been the issue for why young Chinese households have been reluctant to have more than one or two children. So it obviously, population growth and productivity growth is really what determines economic growth. There's nothing else. They're doing fine on productivity growth. They're doing horrendously on population growth. They're not the only ones though, and that's kind of it's easy to focus on China, but have a look at Korea. It's also bad. The only places that aren't really bad, to be perfectly frank, apart from areas in Africa, is India, to some degree the US, and to some degree here. And that's because we supplement it so aggressively, via net migration. So it is an issue, and it depends how far your horizons are stretching there. So if you're looking at 15 years, it's going to be really challenging. If you're talking 5 years, I'm not that concerned. But yeah, I think it's a really valid point to make. If you're setting a portfolio and set and forget, you can't ignore that. It's going to be a really big feature. If your clients are speaking with you and Sarah, then hopefully you're going to be navigating. And Sarah obviously had as one of the key things to think about in her presentation. It is certainly true. Year-to-year movements are normally pretty glacial in these things, but they accumulate over a 10-year horizon and they become really, really impactful. So it's a really important question. Would I change investment philosophies or actions on it today if I saw a marginal shift in the population numbers of China? Probably not. But I would be thinking about how much of a weight I would have purely to China on a 15 to 20-year type horizon. And I think we saw also anyway a lot of investors hedging their bets, and this goes to the Australian dollar argument again, not being too willing to put money directly in China, but wanting to play the adjacencies to China. And money flowing to Australia is basically one way to do that. You're kind of hedging that bet somewhat.
Yeah, makes sense. Thanks, Tim. Well, I'll tell you what, with 3 young kids of my own, I can sympathise with their affordability concerns. Don't worry about that. All right, I think that's all we got time for today. We do have another few questions there in queue, but what we might do is send those through to Tim and Sarah post this session, and we'll get some answers out with the recording of the event. So a big thank you to Sarah and Tim for giving up their time today. Thanks to all our clients for attending and for your support. Hopefully that's been insightful. If you do have any more questions, you can direct those straight to your advisor and they will speak with our investment team. Keep an eye out for more events coming your way. We look forward to catching up soon. Thanks, everyone.
Thank you, everyone.